The Fed holds and leaves the door wide open to cut in September. Global stocks and bonds are rallying this morning. Oil prices jump on new conflict in the Middle East. The Bank of Japan hikes and says more tightening could be on the way, and bets the RBA will hike next week are all but off after inflation figures were cooler than expected, and that hammered the Aussie dollar down. That's coming up in our 5 Things in 5 minutes. And then, in our bonus deep dive interview, ANZ senior economist Birch explains what the Reserve Bank of Australia will be looking for to get confidence it can cut rates from February.
One of the biggest questions is going to be in the second half of this year, how much of the boost to disposable income will households spend versus how much they will save? And I guess the RBA is hoping a bit for that middle ground.
But first, in 5 and 5 with ANZ, the Federal Open Markets Committee has just held the Fed funds rate at 5.25 to 5.5% unanimously. The FOMC said they still needed greater confidence on inflation, but they noted progress and softened their language around risks, saying they needed to be attentive to both the Fed's inflation and employment mandates. ANZ economist Bunzi Madhavani says this morning markets continue to fully price in a September rate cut, with about 65 basis points of cuts priced in through to the end of the year. It's almost 3 cuts.
They have certainly kept the door open to cut in September. They acknowledge that inflation has eased somewhat, but said that they need more progress for them to be confident to begin cutting rates. In that sense, the Fed maintained a data-dependent stance, and they've kept the guidance pretty neutral, and they've not tied themselves to a date-dependent guidance. But we think the Fed will be on track to cut rates beginning September. It all comes down to inflation development from here on, and also the labour market development between now and September. The Jackson Hole Conference, which comes up in August, also will be important in terms of guiding market expectations.
Shortly after the FOMC decision, at 4:15 Sydney-Melbourne time, the Australian dollar was trading down 0.2% at 65.22 US cents. It was hit yesterday by Australia's weak CPI data. The Kiwi was trading up 0.5% at 59.36 US cents. Number 2, the Bank of Japan yesterday lifted its policy rate by 15 basis points to 0.25% and announced a quantitative tightening plan to reduce purchases of Japanese government bonds. Bunzi Madhavani says the BoJ maintained hawkish guidance on future moves.
Our read is that they want to normalize monetary policy over time, given that it is currently extraordinarily accommodative. So we expect one more rate hike this year. We are penciling in 25 basis point rate hike in October. But that said, it's important to note that BoJ's policy will continue to remain accommodative for a while. Even with the rate hikes, the real policy rate will continue to remain significantly negative, which means monetary policy will not weigh on growth and activity.
Number 3. Expectations of a rate hike in Australia fell yesterday as annual inflation figures printed in line with the Reserve Bank of Australia's 3.8% forecast. That was up from 3.6% in the first quarter. However, it was below the market consensus of 4%. The trimmed mean CPI measure of core inflation was 3.9%. That was a little bit above what the RBA had, but down from 4% in the first quarter. ANZ senior economist Birch says the data saw any expectations for a rate hike vanish, with markets pricing in a full 25 basis point cut in February.
Australia's Q2 CPI data support our view that the RBA will hold the cash rate at 4.35% at its meeting next week. These results won't be enough to convince the RBA that it can't return inflation to target by 2026 under current policy settings, particularly given the backdrop of the ongoing slowdown in the broader economy and the labour market, as well as more central banks shifting into easing mode overseas as well. And while price pressures have picked up a little this year, we have seen bumps in the road in other economies as well. Most recently, the US early this year, before that process of disinflation returned. But the underlying trend that we see in the data is still down.
Number 4. In other market news, oil was up around 3% on escalating tensions in the Middle East. It's also been a big 24 hours in currency markets. The Aussie dollar initially fell about 0.7% against the US dollar in local trade after those CPI figures. And Japan's finance ministry confirmed 5.5 trillion yen, that's 36 billion US dollars, of yen purchases over the past month in interventions. Also, the Kiwi dollar rose to a new monthly high of over 91 Australian cents after that Australian inflation data. Here's ANZ Head of FX Research, Marja bin Zaman.
We saw the dollar-yen pair touch the highest level in 4 months, pushing below the key 150 level, with 2-year yields jumping to the highest in a decade. So clearly this has come from a carry unwind that we have seen over the past week or so. We've seen dollar-yen move more than 7% since its high earlier this month. It was interesting to see Ueda's comments at the press conference, where he did kind of indicate that the weak yen's inflationary impact, or the weak yen, was raising input costs, and that kind of adds to the conviction that perhaps the yen can strengthen further from current levels.
Number 5. In New Zealand, business confidence surged during July, with the headline ANZ Business Outlook measure up 21 points, and firms' own activity outlook up 4. ANZ New Zealand Chief Economist Sharon Zollner points out that this was off a very low base.
Past own activity dropped another 6 points to minus 24, so that's very low. The hurdle for improving on that is quite low. So there's a bit of a can't get any worse vibe to it, but I do prefer to take a more optimistic take on it than that. I think businesses can see light at the end of the tunnel. Mortgage rates have indeed already started falling.
Sharon Zollner there. Now, in our bonus deep dive interview, ANZ senior economist Catherine Birch explains to my colleague Alex Tarrant what drove yesterday's rise in headline inflation in Australia, but also why the RBA might be quietly pleased that was in line with its forecast.
What are you seeing in terms of the tradables versus non-tradables mix? Is that heading in the right direction?
Well, tradables inflation was actually quite strong in the quarter, up 1.7%, and that followed 2 consecutive quarters of deflation. Now, things like food contribute to that, some of the household goods, but I think where we saw quite a bit of strength was in the clothing and footwear category in this quarter, and more strength than we would expect given the weakness in the consumer environment that we've seen. But actually in the retail sales data that was out at the same time, we have seen quite a bit of spending on those end of financial year sales. But the strength in tradables may also be influenced by things like the higher shipping costs that we've seen over the first half of this year, and they continue to rise.
And how about that domestic inflation that everyone's really trying to beat down with a big stick?
Domestic inflation pressures, so those non-tradables and the services inflation, eased in Q2. Now, there's a little bit of seasonality there, but they're still probably running a bit high for overall inflation to be consistent with getting back to the target band and actually staying there sustainably as well. So we think that the RBA is going to want to see those domestic pressures continue to ease over the second half of this year before they actually start cutting rates. And that's a key reason why we don't see the RBA cutting rates for the first time until February next year. We think that we won't get enough data coming through to actually convince them of that for a rate cut in 2024.
Just take us through the comment in your note that this won't be enough to convince the RBA that it cannot return inflation to target by 2026. Are we sort of in, I guess, given the market expectations before the print, are we in this, is it a bit more of a Goldilocks print than most people expected?
Yes, there was quite a bit of discussion about the upside risks, the risk of the CPI prints coming out at 4% or above 4%, so a larger margin above the RBA's forecasts. And there were some pricing for a rate hike coming up by markets as well. But this is, I guess you could call it a bit of a Goldilocks print. It's pretty much in line with what the RBA was expecting. We're also seeing this slowdown across the broader economy, but not a sharp deterioration that the RBA will be happy to see as well to help close that demand-supply gap. The RBA will be watching some of the key data releases really closely over the next few months, particularly the monthly CPI, labour market, retail sales and the NAB business survey as well, to get a rounded view of what the economy is doing. And we'll also get the Q2 GDP coming through in early September as well. I guess one of the areas that will be of focus in the second half of this year is household spending, particularly because households are now seeing those stage 3 tax cuts show up in their bank accounts. Cost of living relief measures are also starting to come through as well, so they will boost household disposable income. So one of the biggest questions is going to be in the second half of this year, how much of the boost to disposable income will households spend versus how much they will save? And I guess the RBA is hoping a bit for that middle ground.
Catherine Birch there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, August the 1st. Catch you tomorrow with the Bank of England's rate decision and further reaction to those FOMC and BoJ decisions. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.